Ladies and gentlemen, good day and welcome to Max Healthcare Institute Limited earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you, Mr. Pujari.
Thank you. Good afternoon, everyone, and thank you for joining us on Max Healthcare Q3 and 9M FY22 earnings conference call. We have with us Mr. Abhay Soi, Chairman and Managing Director, and Mr. Yogesh Sareen, Senior Director and Chief Financial Officer of the company. We will begin the call with opening remarks from the management, following which we'll have the forum open for interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks.
Good afternoon, everyone. A very warm welcome to all for joining us for the third quarter earnings for Max Healthcare for the current financial year. Let me give you the key highlights of the past quarter before opening up the forum for Q&A. The third quarter was largely a normalized quarter except for the lower international patient footfalls. Despite it being a seasonally lean quarter and having minimal revenue from COVID vaccination compared to previous quarters, we continued our strong business performance and reported growth in revenue as well as EBITDA, both in absolute and margin terms. Some of it is driven by the action taken to improve the payer mix and continued focus on strengthening our medical programs. The following are the key highlights for the third quarter performance. Network gross revenue stood at 1,392 crores, a growth of 20% year-on-year. This includes rupees 7 crores from vaccination compared to rupees 91 crores in the second quarter of financial year 22. The gross revenue excluding vaccination grew 20% year-on-year and 3% Q-on-Q. The contribution of digital channel continues to be at 11% of the overall revenue. We achieved the highest ever operating EBITDA of rupees 364 crores in the third quarter of the financial year FY22, as compared to 337 crores in the second quarter of the current year, reflecting a growth of 8% quarter-on-quarter and 44% year-on-year, excluding vaccination. The EBITDA margin was at 27.6% and PAT was at rupees 252 crores. This is the fifth consecutive quarter where we have recorded the highest ever EBITDA and operating margins. As stated earlier, we had been working on improving our payer mix by reducing the bed share of institutional patients, relatively a lower ARPOB channel. During the third quarter FY22, the bed share of institutional patients is down to 31% as compared to 37% in the second quarter of FY22, partially due to the voluntary disempanelment of few institutional accounts at some of our network facilities. This well demonstrates our ability to improve payer mix during quarter with normalized patient footfall. The average revenue per occupied bed improved to the highest ever of rupees 61,000 as compared to 59,000 in the previous quarter, implying growth of 22% year-on-year and 3% quarter-on-quarter. We continued delivering industry best EBITDA per bed, and it stood at rupees 60 lakhs for Q3 FY22 as compared to rupees 55 lakhs for the previous quarter, that is Q2 FY22, a growth of 9% quarter-on-quarter and 49% year-on-year. Cash generated from operations after interest, tax and replacement capex was rupees 212 crores, while rupees 250 crores was invested in growth initiatives, leading to slight increase in net debt to rupees 296 crores as at the end of December 21. During the quarter, we have fully paid the balance amount of the remaining 75% for the Gurgaon land and purchased TDR for a cost of rupees 180 crores. We have also paid rupees 55 crores to the Municipal Corporation of Greater Mumbai and for capex for the permissions to commence expansion of Nanavati. And the balance further investments were made towards our other ongoing expansion projects, that is those for Max Shalimar Bagh and Max Smart at Saket. On the COVID front, the admissions continued to be low during the third quarter, with only 1% of occupied beds being used for COVID patients. Also, the COVID-19 vaccination rate declined dramatically. During the quarter, we also served 35,000 indigent patients in IPDs and OPDs free of charge. The notional value of this treatment was rupees 44 crores. Further, the international patient footfalls did see a jump during the course of the quarter, and the revenue grew by 68% quarter on quarter. However, this was still two-thirds of the pre-COVID run rate. Talking of our SBUs, Max Lab, which is our non-captive pathology business vertical, we added 90 channel partners during the third quarter FY22, taking the overall active clients to 700 plus, spread across 24 cities. Non-COVID revenue grew by 81% year-on-year and 5% quarter-on-quarter, while COVID-19 related revenue declined. Max at Home reported improved performance with gross revenue of rupees 28 crores, representing a growth of 41% year-on-year and 3% quarter-on-quarter. The performance of the third quarter is consistent with that of the previous two quarters, and overall, our network operating EBITDA for the 9 months ended December 2021 was rupees 1,085 crores, which is 2.5 times of the EBITDA for the same period in the financial year 2019-20. To summarize, we continue to scale new heights on most of the key operating and financial parameters. Post-abatement of COVID-19 pandemic, in the last 6 months, we have announced 4 transactions having the potential to add 2,200 beds to our network. Of these, we plan to operationalize 1,500 within next 5 years. In addition, we also have an ongoing plan in offering to expand our existing network facilities by 1,300 plus beds over the same period. Hence, collectively, we will be adding 2,800 beds in next 5 years with expected capital expenditure of rupees 3,700 crores. That can easily be funded through internal accruals alone. Further, given our strong balance sheet coupled with robust free cash flows, we continue to focus equally on value-additive inorganic growth. The pipeline of further acquisitions continues to be extremely strong, and we will ensure we are judicious, disciplined, and focused on the opportunities providing low risk with strong upside. I will provide you a quick overview of the 4 transactions consummated by us in the last 6 months. The first one entailed acquiring the right to aid development of a 500-bed hospital on 3.5 acres of land of Vikrant Foundation, falling between the 2 existing Max hospitals in South Delhi. This small value but big acquisition paves way for an integrated medical complex spread over 23 acres of land with a potential for 2,300 plus beds at a prime location in Delhi. Max Saket is operating at an EBITDA per bed of greater than rupees 80 lakhs, which is one of the highest in the country with a high occupancy of 75%. The second transaction involved allotment of 2 parcels of land in Gurugram, aggregating to 11.4 acres, enabling addition of 1,000 beds in well-inhabited areas. Gurugram is one of the most profitable hospital markets with competitors running at high occupancy with high ARPOB. Our existing facility in Gurugram also yields us the highest EBITDA per bed of greater than rupees 85 lakhs within our portfolio of hospitals. The third transaction consummated last month was for a 300 plus bed hospital in the attractive micro market of Southwest Delhi. This is an asset-light model of expansion that we have talked about in the past. and offers very attractive ROCE with minimum development risk. Max Healthcare's investment will be restricted to 1/3 of the project cost. Max Healthcare has entered into a 60-year long exclusive operation and management agreement for the upcoming hospital in Sector 10, Dwarka. We did not have footprint in this region, and the upcoming 300-bed hospital is well located on a 45-meter wide road, open from all sides and accessible through the metro corridor and Dwarka Expressway. The structural work of the hospital is near completion, and we expect to commission the hospital in the first half of the financial year 2024. The latest transaction is more like a brownfield expansion with the potential to add 400+ beds in East Delhi region, where we already have a presence through a 400+ bed Max Super Speciality Hospital at Patparganj. The site is again on a metro corridor and 800 meters away from our existing facility. Most of you may be aware that for years, Max Hospital at Patparganj has been operating at extremely high occupancy, upwards of 81%, resulting in delayed admissions and limiting our ability to expand upon our clinical programs there. In order to cater to both and growing demand of the micro market, as well as increasing our bouquet of offerings, we have embarked upon an expansion through this transaction. This new hospital, along with our existing facility, will synergistically allow us to cater to the need for quality healthcare of the community in East Delhi and strengthen our network footprint in NCR. The 400 beds will be set up on 2.1 acres of land falling on Delhi-Meerut Expressway. We expect to commission 250 beds in the first phase by the first half of the financial year 2026, and the existing 20 beds will be dismantled in due course of time. The overall project cost, including land, would be upwards of rupees 650 crores to be incurred over the next 5 to 7 years. This addition is through a long-term medical services agreement model, and thus the new hospital will be considered as a partner healthcare facility. We are happy to have executed these 4 transactions to significantly augment our network capacity in the National Capital Region in the coming years. Looking ahead, we see a clear growth path through the following levers. 1, addition of beds organically in the existing network hospitals. 2, return of international business to pre-COVID levels and grow beyond. 3, improvement in payer mix towards non-institutional channel. 4, impact of senior clinicians onboarded and continued strengthening of medical programs in the last quarter. And finally, on the digital front, we continue to invest in technology to build digital solutions that will help us serve our customers better and keep them engaged. Besides building an all-in-one mobile app, we are also actively working on an integrated data lake to support multiple applications across the patient journey. The offerings will include hyper-personalized patient engagement, one patient view for stakeholders and care providers, a 360-degree intelligence for management teams, and ability to channelize the data for both innovations and research, leading to future streams of revenue. We did see some softening in occupancies towards the end of December due to onset of a third wave of COVID-19 infections, and this continued throughout January. However, in February, we are seeing a sharp recovery in occupancy, and it is currently hovering around 70%. The electives are above, and OPD footfalls are near to normal. We expect occupancies to normalize in March itself. On this note, I would like to open up the forum for question and answers. Thank you.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. The first question is from the line of Praveen Sahai from Edelweiss Financial Services. Please go ahead.
Hi, sir, and thank you for taking my question, and many congratulations for a good set of numbers. So my first question is related to the very strong performance across the major specialties. You had delivered last quarter, this quarter as well. So should we see this YOY and the sequential growth for a quarter in the seasonally weak, which is because of some pent-up demand post-COVID, or do you believe this numbers to continue from here, or once the pent-up demand will subside, these numbers to go down in the coming quarters?
I don't see a significant amount of pent-up demand really which is driving these numbers, and we also see that international business is not sort of back to normalcy. So from that standpoint, you will have, like I said, that would be a lever going forward as well. You can see even, sequentially, it's a little higher this quarter. This is the 5th consecutive highest ever quarter. Although in a weaker quarter, we had a larger proportion of international business which was 2/3 of pre-COVID levels, which have sort of compensated for. But in a normalized non-COVID quarter, I look at this as the base.
Okay, great, sir. And second question is related to the OP volume. So is that reached to the pre-COVID number? And how is the realization in the the outpatient? Or you can give us some contribution, how much it contributed in the top line?
Yogesh?
So can you repeat the question, Kunal? So you said basically what is the contribution of the OP pharmacy in the contribution? That's what you
OP numbers you have given, that's outpatient numbers you had given. I just wanted to know what's the contribution in the top line in the revenue terms, and is that the number reached to the pre-COVID number, and how is the realization? Realization has softened there. How is that in the outpatient?
Yes, sir. In the OPD concern, you would have seen that the numbers have come down as compared to Q2. Some is because of vaccination, and also some of it is because of the fact that this is a lean season for the OPD footfalls. I mean, if you compare the data from FY18 onwards, you'll find that Q3 is generally lower than Q2. So there's obviously some softening which has happened, but that's seasonal. Now your question on the contribution, I would say around 13 to 14% of the revenues is coming from the OPD, which includes the OP pharmacy, etc. Typically 3 to 4% of the revenues come from OP pharmacy, and balance is all consults and other elements, and pathology, radiology, and other stuff.
Okay. There is no realization impact.
No, so there's no realization impact, but obviously, overall contribution of OPD is lower than what it used to be, and it's more because of seasonal factor than anything else.
But there is no significant aberration.
Okay. The next one is related to international, because international has also increased significantly for the quarter. So from which geography you are seeing the foreign patient coming in this country, because still the restrictions to the international flights are there.
We see some SAARC countries
from Iraq, Kenya, Ethiopia. These are the countries that majorly contributing to our patients' growth.
We've seen some SAARC countries, and we've seen the Eastern European cluster in Iraq.
Okay. And what is the reason for lower tax rate for this quarter?
Yeah, I think we put a note also there in the slide. You'll see basically, there is this this is the fair valuation of the ESOPs. So you get while we have accounted for on the ESOPs based on the fair valuation on the date of grant, but we got advice where it says that when on the date of exercise of these grants, if the price has moved, we can get a higher deduction. So these ESOPs got they were exercised in this quarter. Quite a large part of it, and so to that extent there'll be a tax benefit which will come up in the return, and so that benefit is actually flowing into the tax rate.
Right.
Yeah. And we expect the same rate to apply in quarter 4, and thereafter it will change.
That will helpful. On the acquisition of the Purpleganj, as you had already mentioned that by FY16 you will see the 250 bed to commission. So is it like a 250 bed will come only like directly in the FY26, or is it like a 20 bed already they are operational, so next year some beds are planned or the...
No, the 250 will come in FY26. We'll be creating a superstructure for the entire 400 beds, and we will commission 250 of that, but they have to yet to be constructed.
Okay. And last question, sir, on the Max Lab realization, because their correction we had seen on the YOY and the sequential basis. So is it because only of COVID is subsiding?
Yes, largely COVID, and also you'll find that in October there was some dengue, testing that we did, and the theatre size for dengue is much lower than the normal theatre size, right? And that's how the average is lower than last quarter.
Okay. Thank you, sir. Thank you for taking my questions.
Also, I think the significant investments which have been made in the Max Lab, we've started more and more, points, 140 in the previous quarter, 90 in the current quarter, that all will lead to average coming.
Okay, sir. Okay. Thank you, sir. Helpful.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Nikhil Mathur from HDFC Mutual Fund. Please go ahead.
Yeah, hi. Good afternoon, everyone. My first question is on ALOS. If I look at on a Q&Q basis, ALOS has remained stable at 4.3 days, and there's barely any COVID contribution in this particular quarter. So any particular reason why ALOS isn't trending down further, and can it trend down further from where it is? Because pre-COVID as well, I have 3Q FY20 numbers. ALOS was at 4.3.
So I think the ALOS of 4.3 is what the normal ALOS has been even in the pre-COVID times. So and it's a non-COVID quarter in a way. So and we haven't seen any major change in the midst of these specialties. So to that extent, this is the normalized ALOS that you will see even going forward, in a non-COVID quarter.
Okay. You had now 2 quarters effectively of non-COVID. So the previous quarter and the quarter even prior to that was low on COVID. So I think, sequentially you will have only incremental sort of improvement in loss.
So you're saying that 4.3 can go down to 4.214, whatever. But
so don't look at it in absolute term. Okay, simply because if you have more tertiary care, more quaternary care programs, so if you do more transplants, more higher-end programs, your ALOS is likely to be longer. So you have to be able to compare it to apples to apples. We have significant amount of our beds in critical care, 30% of our total beds in critical care, which is far more than the competition. So what that means is, that allows us to achieve higher ARPOBs because we are doing effectively more complex surgeries, etc. But the fallout of that is also there are longer stays. The more the complex the surgery, the longer the stay is.
Right. Okay.
Right.
So the ARPOB actually flows in the ARPOB. Everything flows, right? So if we are getting the highest ARPOB in the industry, that obviously means that everything is right on that side. To that extent, even if the ALOS is higher, compared to anybody else, but I'm saying if the ARPOB is higher, that obviously means that we are doing the high-end surgeries, and it allows it to be higher than the competition in terms of ALOS. But the ARPOB is still the metric I would say that is compared.
Got it. No, I mean the only reason I was trying to get some understanding on this is because the major bed capacity addition is coming in 24-25. While I can understand ARPOB reverse in the next 12 months or so, I'm just trying to gauge if there's some way of freeing up bed capacities by reducing ALOS. So fair enough. I mean I've got my answer here.
Yeah. So I think the play over there is the institutional part, the payer mix distillation that we spoke about, rather than ALOS. Yeah.
Right.
This
absolutely.
Is sort of highlight the right thing over there.
Yeah. Secondly, on ARPOB itself, if I look at on a YOY basis, and even if I look at pre-COVID, from 51,000 it has gone up to 61,000. Can you break it down into how much actual price hikes have been taken versus payer mix?
So I would say in this quarter hardly any. But otherwise, we take price hike every year in April, and also there are these TPA price revisions which happen 18 to 24 months depending on which TPA it is. So there has been some price increase in end of March. The benefit of that has flowed into this year. That is the GIPSA price increase. And yes, I would say in this year probably the price hike is a bit higher than the usual because of the fact that the GIPSA got revised in this year. But otherwise, 2.5% to 3% is the price increase gain that we generally get in a year.
Sorry, I didn't catch the number. What price hike you were alluding to?
So every year we increase the price by about 2.5% to 3%. Okay.
Right.
But what happens is that your insurance and GIPSA rates, okay, which are basically 18 or 24-month contracts. Okay, so there's a sort of a bunching up and a delayed increase of that. So you don't get that increase every year, but every 2 years there's a bump up which happens. So what Yogesh is saying is in this current year, okay, we in a lot of the insurance contracts sort of got bunched up and we got that incremental increase because it was the previous 2 years increase we were getting. The price increase per se every year is about 2.5% to 3%.
Got it. Okay. And slightly more structural question. Is there any formal, informal study on the Delhi NCR hospital bed supply demand gap? I mean, the only reason I ask this question is that Max continues to believe that Delhi NCR is the core geography and more expansion the company will be taking in that geography. But any formal, informal study, any estimates would you having on the supply demand gap?
So I think there is a Kotak study. There's also a couple of DRHPs, and you'll find this in our presentation. The highest gap between in India between number of total available beds and total number of affordable population, okay, is in Delhi NCR, and then comes Mumbai. Now it also happens because there is a huge amount of concentration of affordable population. The density increases around the metros. That's one. Secondly, 10 to 11% of your beds in any case are catering to international business. About 8% of our beds are totally free for the poor. Okay, so that takes out about 20% of our total bed capacity. Then you look at, close to 1/3 of the bed capacity will be catering to upcountry business, which are people coming from outside the Delhi NCR necessarily. The balance is remaining for the Delhi NCR market. Having said that, this is a top-down. Okay, what we need to look at is expansions on a bottom-up, right? Today, if I see, let's take the case in point of our previous expansion, which is Max Patparganj. We have an existing hospital over there which has been operating at 81-82% occupancy levels, okay, consistently for the last 4 to 5 years. This is midnight occupancy. That means during the day we are operating close to 100% occupancy levels. What that means is that there is a waiting at emergency which can move from many hours in a day, okay, to a couple of days for admissions to your bed or your bed category. So that means there is that amount of unsatiated demand at the back. Also what happens is that, look, if we want to add more doctors, okay, doctors are sort of wanting to attach themselves or come on board a very successful hospital. But the question always is, look, but where are the beds? Where do we admit our patients? Which is right. So our whole success in that micro market becomes our impediment. So what's the choice that you have? The only choice you have is to expand. Now you may look at, demand and supply in Mumbai, but the fact is, let's say Beach Candy Hospital, they have no choice but to build another tower because, the waiting is too long. So it is also, it's a bit of a winner takes all. The top few hospitals will get a lion's share or a disproportionate share of the market. But we also have to look at it on a bottom-up approach. Now, so if you look at Max Saket, where we're looking at expanding, it's already operating at 75% plus occupancy, consistently. We are doing an 80 lakh rupee, EBITDA per bed compared to 60 lakhs for the network. In Gurgaon, similarly, we're doing more than 85, 87, we're doing about 88 lakhs of EBITDA per bed compared to the rest of the network. Okay, we do no institutional business over there. Operates a very high occupancy. Whereas every competitor of ours is sort of operating at very high occupancies and high ARPOBs over there. So I think, these are markets where it is justified, okay, that because there is no other way out. If we don't satiate the demand, then somebody else will.
Okay, got it. And one final question. How many doctors, exclusive doctors, do you have on board in Delhi NCR? And if tomorrow, whatever bed capacity expansion that is happening in Delhi NCR, would the doctor count go up proportionately or proportionately much lower than how the bed capacities will move up? If you can just give some color on this.
No, absolutely. So what happens is the advantage of doing a brownfield, okay, is that you already have onboarded clinical programs and the doctors. So the management, the clinical strength, at least the revenue earning doctors, etc., already there. It's the same doctors who are hungry for more beds because, they have to put patients onto beds. So you don't, your increase in clinicians is not sequential, it's incremental from that standpoint. Yes, when we set up in a place like Dwarka, we'll have to onboard doctors. When we set up in a place like Gurgaon, we'll have to onboard more doctors. But in Saket and Patparganj, that may not be the case. We don't have to necessarily onboard with double capacity to double the amount of doctors. There'll just be incremental increase in doctors. Because the same doctors will be essentially serving those programs unless we expand the bouquet of services, which again is going to be incremental in a purely brownfield kind of a situation. So the advantage is that, look, your ramp up is very quick. Your break-even is almost immediate. Those are advantages of a brownfield. But keep in mind, Delhi NCR, I think we have close to 3,500 senior clinicians. We have overall 4,800. We've got 25,000 healthcare workers. 18,000 of them live in Delhi NCR. We have, significant amount of senior clinicians, like I said, who live in Delhi NCR, who are working exclusively for us. There are about 12,000 GPs which refer business to us. We run amongst the largest home care businesses in the country, entirely predicated on Delhi NCR, right? And a large lab business in Delhi NCR. Now, the fact is, the brand is very well established. And it's much easier for clinical programs to mature because there's a huge amount of cross-reference amongst doctors. So, this sort of geographical concentration and dominance that we have in Delhi NCR allows us or enables us, to sort of set up more capacity to be able to onboard more doctors, because the cross-reference is a lot more. The stickiness of the model is a lot more in the Delhi NCR region.
Thank you so much for taking my questions, and I'll get back in the queue.
Thank you. Thank you. The next question is from the line of Abhishek Sharma from Jefferies. Please go ahead.
Yeah, hi. Just a bunch of questions. First, on the institutional business, I just wanted to understand the salience of this business. Is it more in some hospitals than you run versus the others? And the other question is on disempanelment. So is that going to be the way forward in order to reduce the share of institutional business?
Sure. So yes, it is different percentage in different hospitals. So obviously, that also in a way, shows us what's the maturity of that hospital, and the medical programs therein. For example, we took that call in Mohali. Mohali, we stopped the CHS business. Dehradun still has it. Bathinda still has it. So Bathinda is the highest in terms of institutional business, probably upward of 60%. So I'm saying, obviously, yes, there are different percentages in different hospitals. And we take that call on an institutional basis. Yes, we will be taking, disempanelment is the route to reduce this, this pyramid, or I would say dependence on the institutional business. And we shall be taking that call every 3 months, every 6 months, So we generally take a call, review it, and then, take the next call. So I would say every quarter, or I would say every 6 months, we shall be reviewing this business and taking calls. As I mentioned this earlier also, that every 6 months to 9 months is when this renewal comes up. And we can at that point see that stage, may not sign the empanelment. And that ultimately leads to disempanelment. And obviously, we have to take care of the patients. We have to soft land it. We can't do it abruptly. We have to give them notice, tell them this is what we're going to do, etc., etc. So but that is the only way.
So I think, Abhishek, directionally, we've stated that we will be reducing our dependence on institutional business. Not because essentially we want to, because now is the time we have to. We are running out of bed capacity. Our large parts of our bed capacity, brownfields and greenfields, will come into play a few years down the line. In the midst of this, our preferred channel is growing. That preferred channel now has to start substituting the institutional. The only way to do that formally is to disempanel. The rate of disempanelment increases or decreases, depending on the normalcy of the quarter. So directionally we should have been going down this path a lot sooner, but we've seen switchover quarters from COVID to non-COVID. We've demonstrated that in a non-COVID quarter, our reliance comes down dramatically. We can bring down our reliance on institutional. So if we see sequentially more normalized quarters and international coming back, you'll see this number go down further. But that's the way forward.
Perfect. And just from my point of reference, is it fair to say that Saket would have the least institutional business because it is the most mature?
No, I think Gurgaon is the least, is zero, because it's this thing. Also, it's a function of occupancy. The higher occupancy that you have in a place, the lower will be your institutional business.
Got it. And as a share of revenues, this has now gone down to 19.4% in this quarter, a remarkable decrease versus last quarter. Where do you think this number will settle eventually once you're done with this region?
So, look, I think the important thing is that 30, and I think you sort of pointed out, we have 31% of our beds catering to institutional business, right? And it's leading to 19% revenues. It's been our stated position that we will be bringing it down, or it should come down to about 15% or lower in the next couple of years. So sequentially, what will happen is that your total amount of revenues coming through it will more than half. It also allows you an ability to generate a 40 to 45%, because we're not keeping these beds idle. These beds are being replaced by the preferred channel, which allows you to generate 40 to 45% higher revenues, from the same bed. And 85% of that essentially comes down to EBITDA. So, there's an exponential increase, benefit from it. As well as the fact that ALOS improves, because when the government is paying, people tend to stay longer. Your receivables improves because, when you don't have government receivables, the rest of our business is a cash business essentially.
Sure. So you're basically saying that the bed share will go down from 31% presently to below 15%, once we are done with the... Okay, got it. And the other... Sorry, please go ahead. In the next few years, yeah. The other question I had, in 2 years.
In about 2 years, yeah.
Okay. The other question I had was on the Nanavati VRS scheme. The presentation states that the scheme closed down in November. So just wanted to get some more color there. How many people availed of the scheme? And do you need to go in with an extension of the scheme in future? What's the thought there? Thanks.
I think Yogesh can give you exact listing, but typically the schemes happen in 2 or 3 phases. Okay, you typically have a first round, X amount of people take it up, then you have a little bit of abatement, and then you have a second sort of round of scheme. But I think the details that Yogesh can provide.
Yeah, so Abhishek, basically 69 people applied for it, 62 applications we accepted. There's a payout of 9 crores that we did. The average number of years for the people who took the VRS is 25 years service. So overall payout was 13 crores, including gratuity and other retirement benefits, etc. So as we see December onwards, I think we have a saving of roughly 9 crores a year from these VRSs, and to that extent it's 1.5 crores, 1.5 years of payback that we see from this payout that we done. As I mentioned, we will launch these schemes later. So this scheme is closed, but that doesn't stop us from launching another scheme. I think we are at this point of time working on the productivity of the people in Nanavati, and once we have that dealt with, then probably we'll launch another scheme.
Perfect. Thanks, Abhay. Thanks, Yogesh sir. Thank you.
Thank you. The next question is from the line of Sonal Gupta from L&T Mutual Fund. Please go ahead.
Yeah, hi. Good afternoon, and thanks for taking my question. So just on Delhi NCR, I'm just trying to understand, clearly I understand that the demand is very strong across the network for you in the region, and clearly understand the expansion plans. But I'm just trying to understand, because we are setting up high-end tertiary care facilities everywhere, including Gurgaon, Dwarka, everywhere. So, you think that's the model, or I mean, I'm just trying to understand, is there a certain amount of hub and spoke also which is possible within the network?
Look, I think the basic aspect of setting up high-end tertiary care facilities in metros is that it's not only the demand and supply of the metro, but also the demand and supply of the rest of the domestic market as well as the international market. The reason for that is that, look, hospitals like these high-end tertiary care are representative of the best of Indian clinical talent. Because although you have a shortage across the country of high-end clinical talent, it is you have inordinate amount of supply in the metros, simply because most senior clinicians, etc., do reside, like most professionals, do reside in the metros. Their kids have to go to school and college, etc. So as you through digital higher proliferation of insurance policies, higher amount of awareness of this thing, etc., we are seeing the market growing rapidly. So what that means is that there is a need to set up these facilities, both for your own micro market where you're present, but beyond as well. So I think that is really the justification from the top down. But like I said, from even the bottom up, if your capacity is already bursting at the seams, you have no choice but to have another hospital adjacent to that. So that is where we are as far as the expansion part is concerned.
I mean, so incrementally, I mean, given what all we've announced, do we see further footprint addition like in Noida or some other places also, or do you think that largely we've now covered this geography and future expansion will be in other geographies?
It's not an overall geography sort of this thing alone. I think if you look at Noida, there could be opportunities over there. But again, it needs to be very, very sort of specific opportunity, right? I think the location, where it is, etc. I mean, if I have to do a greenfield in Noida, I probably wouldn't. If I have to get a very, very good listing on a great location on asset-light model and so on and so forth, compelling reasons to look at it, we will definitely look at it. If there is an opportunity to buy out a pre-existing hospital which is already operating at high sort of utilization where we can do improvements like we've demonstrated in the past, of course we will look at those sort of situations. So it really depends on a case-to-case basis. But so I hope I'm able to answer your sort of question. So it's not setting up capacity for the sake of setting up capacity. We are setting up these capacities because we are seeing compelling reasons to. And each one of these is accretive to an ROCE. Our present ROCE levels are 32% and plus. These opportunities we are looking at is 35 to 40% ROCE plus. It's project IRRs of more than 25%. So each one of these become compelling reasons and low-hanging fruit for us. So it's just not expanding footprint for the sake of it.
Got it. And just on these two new additions, Patparganj and Dwarka, what sort of, is there any revenue share involved in these two?
So in Dwarka, yes, but not in Patparganj. So Dwarka, yes, there's a minimum operating surplus that's supposed to be paid to the owners, and also there will be a variable share after 12 years. We do think there will be a 4 to 5% kind of charge that will come to the P&L in the 13th year.
Got it. So overall, what is the capex? Sorry.
No, so the Dwarka is the typical asset-light model. 2/3 of the total project cost is incurred by the developer. Okay, like I mentioned, our 32% is the ROCE levels. So if you actually see, we're incurring only 1/3, and we are servicing that 2/3 through a revenue share. Okay, sort of this thing, but wherein the yield we are providing is about 7.5% to 8% at best. So if you are servicing 2/3 of the capital of that, and you've been able to insulate yourself from the development risk, that means time and cost overruns entirely to the account of the developer in this particular situation. That means 1/3 of capital, the ROCE has become significant.
Got it. And just so overall, given all the plans that we have, what is the total capex now you're expecting for this year and next year and maybe 24? I don't know.
So I can give you a perspective on the capex for next 5 years if you want. So basically, it's going to be 2,840 beds that we're going to add, right, from now to FY27. The total spend is around 4,000 crore, which includes the land spend around 500 crores of land. And of this 4,000 crore, 343 we already spent in this year. There's a 622 crores of cash lying on the balance sheet, which means that we have to spend another 3,000 crore we have to generate another 3,000 crore from here to FY27 for all these capex. And as I see, this should be around 40-45% of what we're going to generate. So which means that from what we have on the balance sheet and what we're going to spend in future, it only uses up 45% of the cash that we have generated. So all the perspective, the full perspective on what this capex look like and what is the kind of cash generation that we're looking at.
Sorry, but could you give what is the full capex expected this year and for next year? What is the number?
So this year capex is around 600 crores, including the cost, including the land, and next year is 686.
Got it. Sure. Thank you. Thanks.
Of that, in the current year, we already incurred. So if you're looking at incremental, that's not incremental. Right.
No, I'm just looking at
343.
Yeah, 343 has been incurred. Sure. Thank you so much.
Thank you. The next question is from the line of Amit Kadam from Canara Robeco Mutual Fund. Please go ahead.
Hi, Amit.
Yeah, hi, sir. So my question was on this occupancy. So where you mentioned that the current February occupancy is 70.
Amit, sorry to interrupt you.
Yeah, sorry.
Speak louder.
Okay. So my question is on occupancy. So in the Feb month, where you mentioned that the current occupancy rate is standing at 70, I assume it is for the overall thing. It is not only, we are not indicating for the non-COVID. Am I right?
No, that's right. So, you had basically an Omicron sort of wave where electives went down, but your COVID patients didn't really come because they didn't require much hospitalization. The numbers had gone down. MTD, it's about 70%. As we speak, it's 70-73%. So we are assuming that it comes up towards the end of it's already on its way up, right? But this is overall occupancy.
Yeah, overall. So basically the point was I was just doing this backward calculation. So maybe that the 15% of the bed.
Can you speak up? We're not able to hear you.
I'm like trying. Okay. So the 15% bed what we have allocated to the COVID, is it fair to assume that they were like only 50% occupied? Hence it was just overall number was been at the lower side.
No, you didn't have really any allocation specifically for COVID. So you did not have 50% beds allocated for COVID from that sense.
Because in one of the presentation slide, you have mentioned that the occupied bed split was 15 and 85 in the month of Jan.
That's right. So this is if there are 100 beds being occupied, then 15% were occupied by the COVID patients, 85 by non-COVID patients.
It's not an allocation.
Okay.
It's number of beds occupied. So that the number of, so tomorrow if the occupancy of COVID is down, we repurpose those beds for non-COVID, right?
Okay. Got it. And just like how different it is in this wave 3, the ARPOB for the individual segment, is it still that the same old ratio of like 40,000 to 6 kind of a number still comes from that COVID?
No, I'm not able to get your question. So what is
what is like in the wave 3, because it was not a serious COVID.
Are you referring to the existing quarter? Which is ongoing
the quarter gone by, or maybe in this wave 3, just wanted to know the indicative level. What was the ARPOB for a COVID segment for the wave 3?
ARPOB was obviously lower than the last ARPOB because last time there was a lot of ICU patients also there, and I would say it will be probably 15-20% lower than the last wave of the COVID patients.
But then the occupancy itself is so low that it doesn't really move the needle, right?
Yeah.
Okay.
No, it's not ARPOB. ARPOB is obviously lower for Omicron because the acuity of the patients are lower.
That's right. I'm just saying the number of patients is so low.
Yeah, that's right.
Really...
Fair enough. That's just what, I had just only few queries. Thanks.
Okay. Thank you.
Thank you. The next question is from Damayanti from HSBC Securities. Please go ahead.
Hi, thank you for the opportunity. My first question is, in one of your slide, you mentioned the current mix between surgical and medical is around 51 to 49. So, Abhay, you mentioned that you are working on a lot of initiatives to strengthen the clinical offerings and other steps. So, how do you see this mix moving up in next 3 to 4 years from now? And can you talk about some of the key initiatives which you are working to improve your clinical programs?
I think first and foremost, we can't look at it on a quarter-on-quarter basis. You should actually look at it on an annual basis because certain quarters have more medical.
So I asked, in next 3 to 4 years, how do you see this mix improving or changing?
Right. So I see this essentially change by onboarding more and more senior clinicians like we've been doing in the past. But having said that, in our case, the clinical mix is quite superior. It in fact compensates both for the lower pricing increases that we do per year, as well as the inferior payer mix that we have that there's an opportunity for. So any improvement over there, will be incremental, not exponential. There won't be any step sort of increases because we're already playing off a large base over here. And we already, like I said, significantly ahead of the pack as far as of the peer group as far as clinical ratios are concerned. So I don't see exponential increase here. I only see incremental benefit coming out of a clinical mix.
Okay.
For me, the bigger driver is the payer mix.
Okay. So payer mix is key, and then here also we'll see improvement. But you mentioned it won't be, I'll say, exponential kind of change from the current level.
The payer mix you will see exponential.
Just in the oncology, right? So our largest specialty is oncology, and oncology does have a lot of medical business, right? So there's a chemotherapies and medical oncology which happens. So obviously, to that extent, you find that the ratio maybe even lower than competition when you see the revenue surgical medical mix. But I think the fact is that the ARPOB in oncology is the highest, right?
Okay.
And so to that extent, as long as we have the highest ARPOB, to my mind, this shouldn't really come into play. You know what I'm saying?
Got it. And my second question is, you're obviously, I'd say, very strongly placed against your competitors in terms of getting the best medical talent in Delhi and NCR region. So can you speak a bit about the competition in this space in terms of getting and retaining the best talent, and how has been doctors' payout change in last few years in terms of safeguarding against the competition?
So I think a couple of things you have to keep in mind. Firstly, we, like you rightly pointed out, we have a geographical dominance and concentration in the Delhi NCR market. A lot of business of the doctors comes through cross-reference. Because we have more beds in the same area, region, we have more doctors on an exclusive basis, we just have more feet on the street as far as sales and marketing, and more GPs will refer business to us. There's a lot of cross-referrals which happens. Okay, so if you're in our system, the 3,800 senior clinicians within the network are cross-referring to you within the network. So that sort of creates a very distinct moat and your ability to get more and more patients and generate more and more work because of all of these things, as well as being a more dominant brand in the Delhi NCR market. That's one. Secondly, all our hospitals are teaching hospitals. A lot of the doctors, if not all the doctors, have an academic leaning, and there is a huge amount of focus on research as well as academics. The third is almost every hospital of ours in Delhi NCR has about 10% beds, and the most remarkable part is we outperform the industry on every financial and operating metric, but we do it in spite of having 7 to 8% of our total beds across the network. Okay, absolutely free of cost for the poor, which is significantly higher than anybody else in the competition. So doctors and surgeons typically they work, they have an artistic side as well. They're working in the hospital from very early in the morning to very late at night. They also like to see free patients at us. So all of these three things sort of create a moat around us and create a differentiated, a stickiness in the platform. Our total payout is, I think, sub 15%, if not 15%, which is perhaps the lowest in the industry. But that doesn't mean our doctors earn the least. What that means is because our RPOBs are significantly higher than the industry as well. As percentage terms, the payout is low, but in absolute terms, our doctors do generate more. Plus the fact that, look, our revenue has grown by about 13% over the last 3 years without adding any significant capacity. Tells you that we've been able to augment and enhance their own revenues a lot more in the marketplace. So I think, we are in a virtuous cycle as far as doctors are concerned.
Okay, and I understand, like, because of these, I'll say, attractiveness in Max brand, attrition might be very low or it's almost minimal for your doctors team.
Negligible.
Negligible. Okay. So, so those are my questions. Thank you.
Thank you.
Thank you very much. The next question is from the line of Amit Khetan from Laburnum Capital. Please go ahead.
Hi, thank you for the opportunity. Abhay, just a follow-up to some of your earlier responses. How are we looking at expansion outside of NCR? Are there any greenfield or inorganic opportunities we are currently pursuing?
So look, I think, very clearly what we see is that, there are two sorts of risks in the hospital business. One is the operating risk and the other is the development risk. In a brownfield or in a geography which is a brownfield, the development risk is absolutely minimal simply because you're expanding in the current facility. You already have incumbent hospital over there. You have a certain amount of, dependence, codependence with the local administration, etc. So our development risk is low, and the fact that you're kind of tapping into unsatiated demand in a brownfield, your operating risk is the lowest, and the ramp up is much faster. You already have the clinical programs and so on and so forth. Second would be looking at greenfields within the geographies that you're prevalent in and successful in. In those places, typically development risk is slightly higher because it's not in the exact vicinity of your hospital, although it's in geography. But again, the operating risk again is slightly higher because you may be dominant in the geography, you understand the market, there's unsatiated demand, but it is not direct unsatiated demand that you're tapping. Thereafter comes opportunities, and which I've been sort of always said, we would look at other territories where at least 2 or 3 of our competitors have proven viability because we believe we can operate better. But these are places, and we may not be present in those geographies. These are places in which both, the operating demand relatively is higher than for the first 2. Of course, it is not the same as going into uncharted territory where it's the most. But, and the second is the development risk. The development risk is the highest because we don't operate in those territories and those things, etc. So we will never be doing a greenfield in such geographies. We will only be getting into an asset-light model where, somebody else is developing and taking the time and cost overrun risk. We insulate ourselves from that. So that, of course, going forward, it's not as if, if I get a compelling reason to be in or a great land asset in Chennai, or in Bangalore, I won't be present there. Of course, I will be, but we don't want to make the mistake of some of the others. To be sitting after making investment for decades for occupancy certificates. We would rather give it to the local developers. They can take on that risk. We are happy to take on the operating risk in other metros and maybe in other tier 1 cities.
Understood. That's very helpful. And secondly, you've detailed out a capex plan in one of your slides. Just wanted to confirm if that includes the maintenance capex, and if not, how should we be looking at it on a per bed or a per year basis?
No, it doesn't.
Maintenance capex is about 125 crores a year. It does not include the maintenance capex because maintenance capex is aside from this.
Sure. So 125 crores is something that we should pencil in for next few years.
That's right. That is in addition. That is the maintenance capex on an existing facility. But like mentioned, I think even Yogesh mentioned that we will only be using a portion of our free cash flows going forward through internal accruals for these capexes. We don't need to sort of take any debt or.
Got it. Thank you and all the best.
Yeah. Thank you.
Thank you. The next question is from the line of Hemant, self-employed. Please go ahead. Hemant, may I request you to unmute your line from your side and go ahead?
Yeah, sir. Hello, sir. Thank you for taking my question. First of all, I would like to know, if I am not wrong, that 300 plus bed, which is an asset-light model in Delhi, is going to be commissioned in the first half of FY23, right?
24, no?
24. Okay, first half of FY22.
First half of 22 will be 6 months down the line. FY24.
FY24. And sir, what?
15 months or months, right?
And sir, what about the 250 beds out of 400 plus beds in East Delhi?
So we mentioned that's going to be FY26. 26, right?
26. Okay. So, sir, one more question. Like, what kind of revenue guidance are you giving for the next fiscal year?
I'm not giving any revenue guidance for the next fiscal year.
Okay, sir. Thank you.
Thank you. The next question is from line of Abhishek Sharma from Jefferies India. Please go ahead.
Thanks for the follow-up. Sir, just wanted to get some sense on these micro markets where you are going. So, Patparganj, you are already present with your, first hospital. If you could just give us some more color on the catchment area, what kind of competitive intensity is there? What is the share of institutional patients in your current hospital there? Just to get some color as to, why you chose East Delhi to expand. And same for Dwarka also, if you can just help us with that. Thanks.
I think East Delhi, we have the numbers. I think as far as Dwarka is concerned, it's the new upcoming emerging market where we've had other players also, including Manipal and a couple of other players which have set up hospitals. They've had a reasonable and good ramp up over there. We are seeing big numbers in that micro market. It is underserved by us. More importantly, I think the threshold over there is very high for us because it's one of the best located and let me put it this way, planned hospitals that I've seen. Your space per bed is almost 2x of what we have in the current district. The entire capital cost of the warm shell as well as land is being incurred by the developer. We are servicing it at sub 8%. So what that basically means is the development risk is off our books. The ramp up over there may be akin to a greenfield, which could be about 3 years to peak to stable sort of 70% plus occupancy levels. But what that means is our total capex is very low. So it's a very forgiving model from that standpoint. As far as Patparganj is concerned, we are already operating at very, very high capacity utilizations. The institutional business is significantly lower than our rest of the network. I think Yogesh will be able to shed some more light on that. But like I said, there's a huge unsatiated demand of that existing hospital, which we are trying to tap into. Yogesh, do you want to give some more color onto how much?
The institutional share is roughly around 15% in Patparganj. And I think there's a large proportion of CGHS patients that we get there. So DGHS we have different panel for DGHS in the last quarter. I think going forward we're going to calibrate this and bring it down. So it's 15% of the revenue.
And you can imagine, this used to be 30-odd% till about a year and a half back. It's come down to 15%, and you can imagine by the time you get to first half 26, where you're going to be.
Yeah, in the last year, same quarter it was 21%. So it's come down 6% in a span of a year.
Understood. And sir, is there any scope for international patient in the Dwarka hospital given its proximity to the airport, or it would basically go? Okay. In terms of the way you are building out your surgical teams, etc. Because if it is catering to the local population, you will build it out differently. So just some thoughts on how you're thinking about that hospital per se. Yeah.
First and foremost, it's a 10-acre, almost an 8.5, 9-acre piece of land, which can be expanded to 900 beds. First and foremost, we are coming up with a 300-bed flagship. A large amount of the doctors, live in Dwarka now. They reside in Dwarka. It's a very sort of concentrated market place for us, and with great connectivity opening up with Dwarka as well. As you would have seen, the third ring road in Delhi is being set up to connect Dwarka with pretty much all of Delhi. So, we believe it's underserved from a community standpoint, so it's going to act as a community hospital and the preferred place for this thing, but also for other markets in Haryana, upcountry, etc. So these are tertiary care hospitals which typically drain from upcountry as well. And like you rightly mentioned, out international because of its proximity to the airport. But I see Gurgaon as more of a play within international relative to Dwarka.
Got it. Perfect. Thank you.
Thank you. The next question is from the line of Praveen Sahai from Edelweiss Financial Service. Please go ahead.
Yeah, thank you for follow-up. Just a clarification, for FY22, how much of the CapEx you have said, 600 crore?
Yes.
And 343 you had done with in the 9 months?
Yeah, that's right. This includes acquisition of land, etc.
Yes. And 125 crore of maintenance is also included in 600 crore?
No. That's exclusive of that. So that's routine CapEx.
Yeah,
we don't have bigger CapEx here.
Yeah. Thank you.
Thank you. And now I hand the conference over to the management for closing comments.
So thank you all, for being on the call. This has been again, I believe, a remarkable quarter for us because the fifth consecutive quarter of growth, both in EBITDA terms and profitability terms. I think what is emanating is a classical sort of a compounding story. We continue to generate significant amount of free cash flows, but we've also demonstrated opportunities to deploy that capital to essentially almost double our capacity in the years to come. In a manner which is highly accretive to our already best-in-class ROCEs, which is 32% plus, and with project IRRs of high 20s. So I think we find ourselves in a very comfortable and keen place, and we look forward to the quarters to come. Thank you so much.
Thank you. Thank you very much. On behalf of Max Healthcare Institute Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.